I joined IG Wealth Management in 2016. I hold a diploma in financial planning through the Canadian Institute of Financial Planning and an advanced certificate in 3H financial planning through FP Canada, as well as a registered retirement consultant and certified financial planner professional designations. I work with clients who have complex financial situations such as business owners, incorporated professionals, and families who have over $250,000, not including the value of their home. I use IG's proprietary software to make these complex situations appear simple and to find ways to make good situations even better. The RESP is arguably the best way to save for your children's education. The growth is tax deferred, you have access to government grants, and when your child accesses the money, they probably won't have to pay any tax on it. Let's assume tuition costs go up 5% per year. What could your child's tuition be in 10, 15, and 20 years? So a university program today could be worth $5,772. In 10 years, that same program would be worth $9,401. In 20 years, that program would be worth $15,314, just based on 5% growth. And what about the cost of apprenticeship and skilled trades training? If your child enters an apprenticeship program, they will spend part of their time in class and part of their time in on-the-job training. Students may have to pay for class time, tools, and equipment. For those of you who've just had children or are about to have children, those 20-year numbers can be alarming. And this is just the tuition or class cost. When you add other education costs and living expenses, the number can be much larger. The Canadian Foundation for Economic Education reports that university students who live at home spend on average about $4,000 per year on non-educational items, and that those who live away from home spend on average $11,000 on non-educational items. A Registered Education Savings Plan, or RESP, is a trust governed by the Income Tax Act of Canada that allows subscribers, usually parents or grandparents, to make contributions on behalf of a beneficiary, usually a child, to save for post-secondary education. The advantages are that it's easy to set up, there's no legal or accounting expenses, and the subscriber retains complete control of the funds. The taxation of all income, interest, dividends, and capital gains is deferred while the underlying assets are held by the RESP. Once the child attends post-secondary education, the income from the RESP is taxed in the child's hands when it's paid out, possibly at a lower tax rate or no tax at all. The RESP growth will be used to pay for post-secondary education, although the parent or grandparent has control over the contributions. In certain situations, the RESP may receive the Canada Education Savings Grant and/or other government funds such as the Canada Learning Bond or provincial grants offered by BC, Saskatchewan, or Quebec. But you can only access these grants if you open an RESP. Disadvantages include restrictions on how much may be contributed to the RESP and restrictions on the use of the RESP's income should the beneficiary not attend post-secondary school. I'll address this later in the presentation. The lifetime maximum contribution for each child is $50,000, and while your RESP contributions are not tax deductible, the plan can grow on a tax-deferred basis. When your child withdraws money from an RESP to finance post-secondary education, the investment income and growth and the government grants will be taxed in their hands. Because your child is unlikely to have much other taxable income, they will probably pay little or no tax on this money. If your child decides to pursue a career path that does not include post-secondary education, the money in the RESP can usually be transferred to a plan for another child or to the contributor's RRSP, subject to certain restrictions and possible repayment of government grants. If you have a family RESP and another one of your children as a designated beneficiary to it, then you can simply allocate the withdrawals to that other child and no transfer is necessary. One of the main benefits of the RESP is matching government grants. The CESG, the CLB, and some provinces also have provincial programs. It's like free money that could provide up to an additional $7,200 in extra investment capital over time. Through basic CESG, the federal government provides 20% grant on the first $2,500 contributed each year. That can add up to $500 in free money each year. Unused basic CESG room can in most cases be carried forward until the end of the year in which the child turns 17. So you can usually make up for lost time if you're unable to contribute in any given year. Additional CESG is available on contributions made to an RESP after January 1st, 2005, and it provides an additional grant above the basic CESG of either 10% or 20% on the first $500 contributed to the RESP, depending on family income. Through the additional CESG, you have the potential to receive an additional $100 each year from the federal government that will be paid into an RESP. So many types of investments can be held within an RESP, such as cash, GICs, stocks, bonds, and funds. We can help you choose which investment type is best for your situation. If you contribute $2,500 every year for 14 years, and then $1,000 on the 15th year, you maximize the CESG and earn a conservative average of 3.75% on your investments. You can have almost $70,000 saved for school after 18 years. A lifetime maximum contribution limit of $50,000 is based per beneficiary, not per plan. Therefore, if you are not the parent of the child beneficiary, it makes sense to discuss your intentions to establish an RESP with the parents of the child to ensure that not more than $50,000 is being contributed for each child by all contributors. Because of the way the CESG program works, many subscribers choose to limit annual contributions to $2,500 per year to ensure the maximum CESG, or $5,000 per year for children with basic CESG carry forward room. The contribution and termination time limits provide ample opportunity for the funds to be used for education purposes, even when the plan is established immediately following the birth of a child. The RESP isn't the only option you have to save for your child's education. You could also use non-registered investments, minor accounts, which are investments in the name of a minor, trusts, both formal and informal, your tax-free savings account, or insurance. You could use critical illness insurance on the life of a child with a return of premium rider. You could use permanent life insurance on the life of the child with a cash value, or universal life insurance on the life of a child, which you can also put a cash value to it that you can access for education purposes. Although a registered education savings plan is the first option for many Canadians saving for post-secondary education, a tax-free savings account can also be part of an overall strategy to help you achieve your savings goals. Note this would be in addition to the parent's TFSA, not the child, as a person under age 18 can't have a TFSA. For example, if you have $5,000 per year to save towards your child's education, here's a few different options how you could allocate it. If you use $2,500 a year to optimize your grant contributions and put the rest into a TFSA, you get the best result over time. If you use half of it to optimize your use of government grants in the RESP and then allocate the rest to a TFSA, you may get the best value. Thank you for taking the time to watch this video. The QR code on the screen will take you directly to our live calendar so you can book a meeting and discuss your unique circumstances and how best to plan for your children's education. Thank you again for taking the time to watch this presentation. I hope this has given you something to think about and that you'll consider partnering with us in your financial well-being.